Hello everyone. In this video we are going to talk about collateralized debt obligations. These are fascinating structures. They can be used both for evil and for good. The 2007-2008 financial crisis is an example of these CDOs being used in a bad way. The crisis was triggered to a large extent by these products. If you have not seen the movie yet, the Big Short, I definitely recommend that you watch that movie because it describes very well what happened during the crisis and what was the role of these CDOs that we're going to talk about. I'm also posting on the website a cartoon that describes the same effect of CDOs on the crisis. The language of the cartoon does not allow me to show the cartoon here in the video, but I definitely recommend that you see that you read that file that I posted on the website. On the other hand, these CDOs can also be used in a good way. As we will see, these structures are able to provide outcomes, returns that are very interesting for investors. So if used in a proper way, they can complete the market, as we will see. So we can get returns from these structures that we cannot get from other securities. Okay. This is also nice, I think, a nice topic to close this course on credit risk, in the sense that it will integrate a lot of the concepts that we have been developing through the course. Okay. Okay, so let's jump to the handouts. So what are CDOs, or collateralized debt obligations? So this is nothing new in the sense that it is just one more instance of something that has been done before, which is called securitization, okay, or debt securitization. So basically what we are doing is we are using some assets, debts like loans or bonds, and we are using those assets as collateral for a second new layer of debt. Okay. So the most common type of assets that we will use here in these examples as collateral, as underlying assets, are exactly the same loans and bonds that we have been talking throughout the course. Okay. Okay, so a more precise definition: what are collateralized debt obligations? So CDOs are financial claims to the cash flows generated by a portfolio of underlying securities. So these underlying securities, again, are this initial layer of bonds, for example, and then we take those bonds and use them as collateral for a second layer of debt, so for these financial claims. Okay. So how does this work in practice? So you have a bank that has a portfolio of, let's say, bonds, and the bank is worried about the risk of those bonds. So what that bank does, which we will call the sponsor bank, they will take the bonds and they will move the bonds out of their balance sheet and into the balance sheet of another company. That other company is called SPV, Special Purpose Vehicle. We can think of this as a small bank, but this small bank, this SPV, does not exist for real. This is just an accounting entity that exists on the books in some country like Luxembourg or the Cayman Islands or some other place like that. So it's just a formal company that is going to take possession of those bonds. Okay, so those bonds come into the balance sheet, into the asset side of this SPV. Okay, so this the SPV will take the assets like we just described here, and if the assets are bonds, this is sometimes called a CBO instead of CDO, and the name people will call these different things depending on the type of asset. So if these bonds are it's a CBO, if it's loans, a CLO, where the L stands for loans, and so on. Some more exotic assets that we can have, and we'll describe this later on, is instead of having here real assets like bonds or loans, we can have credit derivatives like a CDS. And in this case, this structure is called a synthetic CDO. And during the crisis, or before the crisis, I should say, people were getting very creative. And in some cases, what you had here in the asset side was a liability of another CDO. So it was a CDO on top of another CDO, and therefore this was called the CDO squared. Okay, but so let's think of the basic initial case where the assets that come into to here are again bonds that came from an initial sponsor bank. Okay, so this SPV, this firm now has a portfolio of bonds, and now it is going to issue liabilities that are structured in this way. So there is a hierarchy of the liabilities issued from senior notes, which will have typically the best rating, and since they have the lowest risk, they will also have the lowest return. Then there will be an intermediate layer, which we will call junior or mezzanine notes. Okay, they will have still a good rating, not so good as the first ones, but still good. The return will be smaller, but a little bit higher than the previous ones. Okay, it's again the usual risk-return trade-off. And then there will be a bottom layer, which are called subordinated notes. So these are notes. This is debt. Okay, but because it will behave in an equity-like way, we will actually call it equity many times. Okay. Again, this is not equity in the sense that this does not give voting rights for the owners of these securities. This is still just like debt. You just get interest and you don't decide on what the SPV does. But again, we will call this equity because it's on this lower order here. Okay. These notes are typically not even rated because they are so risky that we don't even bother to ask for a rating for this. And they have to have the highest expected return of this bunch, okay, because they are more risky. Okay, so the main thing about CDOs, what distinguishes CDOs from other financial products, is the cash flow waterfall, okay, which basically defines how the cash flow that comes from the assets is allocated to these notes, okay? And the idea is exactly as the name suggests, a waterfall, in the sense that the cash flow generated by the assets is allocated in order from the highest ranked securities to the lowest ranked securities. So in this order here, from these notes to these notes to these notes, okay? And this idea of a waterfall is really intuitive, because it's a good mental image to have, because that's exactly what's happening. So let's see that with some numbers, like in this example that we have here. So suppose we have assets of 300 million that on average give you a return of 8%. So this is the left-hand side, the asset side. On the right-hand side, the liabilities, the CDO could be structured like this. So 3 tranches, the senior with a size of 210, which represents 70% of the 300 million. The width of the loss means that this represents 70% of the assets, so from 30 to 100. But this representation means what? If we are allocating the cash flow from the top to the bottom, it means that if the cash flow is not enough, the losses start hitting the bottom part first. Meaning that I have to have losses in this equity tranche, then this mezzanine tranche, and only if the losses are very high does my senior tranche get affected. So more precisely, only if the loss exceeds 30% of the assets does the senior tranche start to lose money. So the width is written like this, from 30 to 100%, meaning that this tranche is affected by losses between 30 and 100% of the collateral. Okay. So given this, it's very unlikely that a portfolio will lose 30% of its assets. So therefore, it's natural that the credit rating agencies would give this senior tranche a very high rating, something like AAA, right? And let's say that at that moment, this type of debt would require a 6% interest rate, okay? The second tranche, mezzanine, has a size of 60 million, which represents 20% of the 300 million. And again, the width is the size of the tranche from 10 to 30% of the assets, meaning that this is affected by losses above 10% of the assets. If the losses reach 30%, the mezzanine tranche is totally destroyed. Okay? The credit rating agency would give this a rating of, say, A, which would require in the market, at the current conditions, an interest rate of 10%. The last tranche, equity, has the remaining size, 30 million, so this adds up to the 300 million. The loss are the first 10% of the assets, okay? And we would not even ask for a rating to this tranche, okay? So how does this work in terms of the cash flow waterfall? So let's see how this money drips down from the top to the bottom. Okay, let me show you a figure here. All right. So this is my best attempt at drawing a waterfall. You can see that you can see why I did not go to arts, but okay, it's my attempt. So this is the mountain of assets, 300 million, that generate interest at 8%. Okay, so every year 8% of 300 gives you 24. This is in millions, so $24 million every year. Okay, so the water comes down from the assets, and it goes to the senior tranche first. Okay, so the senior tranche was promised 6% of 210, so it has an amount of interest due of 2.6 million. Okay? So only when you have enough money to fill this bucket, to fill the senior tranche with 12.6 million, only if it is enough does the water come down to the next tranche, to the mezzanine. Okay? The mezzanine has a size of 60 and a promised interest of 10%, so every year you have to pay 6 million to the mezzanine. Only if this tranche is totally satisfied, totally full, does the water drip down to the next tranche, to the equity. The equity had a size of 30 and did not even have a promised yield, so it just gets what is left. Okay? So if everything is nice, meaning if there are no defaults, if these assets keep generating this flow of 24, then all these tranches get all the water they want, and notice that this gives a nice yield to the equity tranche. So you get 5.4 over 30 every year, which is a nice return, right? But you can also see that this equity tranche becomes very risky in the sense that you only need a little bit of defaults here on the top, such that the water still fills the senior tranche, which is okay. If you have enough defaults, then this mezzanine does not fill to the top, so you just have a little bit of water, and very, very easily you dry up the equity tranche, and all the fish here die, basically, right? So that's the idea of this structure. Okay, going back to the PDF. So this is an example of how things can go wrong. So now let's just say that over the first year, you have 4% of assets that default. Okay, just to make things simple, just assume that there is no recovery. You get nothing, not the interest, nor the principal. So 4% of the 300 million means that there is a default of 12 million. Okay, so let's see what happens over the first year. Okay, and so here we are assuming that, yes, so we are assuming that the CDO only has 1 year. Okay, so it is issued now, and 1 year from now we receive the principal and interest, and that's it, and we close the structure. Okay, so the cash flow from the assets at the end, at time 1, is going to be the principal, which was the 300 million, but 12 defaulted, so I only have this amount left. Okay, so from this I still get the interest that was defined, the 8%. 8%. Yes, that's how much? Right, 8%. So 8% of this gives me this amount of interest. So the total that I have at the end of the year is the sum of these two numbers here. Okay. So now I'm going to distribute this amount of money, 311, through the tranches, following that waterfall procedure. Okay. So the senior tranche had the principal of 210 and the promised rate of 6%. So I have to pay at the end of the year principal plus interest. I look at the cash flow that I have from the assets, the cash flow available, and since this is more than what I need to pay, I pay everything that is due. And I am left with the difference, so 311 minus 222. Okay, so I'm left with 88. I move on to the next tranche, mezzanine. So the principal is 60, the interest rate was 10, the total principal plus interest is 66. I have still 88, which is more than 66, so I can pay the full 66. And I'm left with the difference, 22. And now I move on to the equity, which is 30. I look at the cash flow that I have available, 22, and that's what I give to equity. All right? So now, if I look at what are the yields of these tranches, the senior and the mezzanine were fine. They got everything that they were expecting. So they get the 6 and 10% that was promised initially. But the equity only gets 22. So it started with 30, gets 22 at the end of the year. So this is already a negative yield of minus 25%. So you can see that this very quickly becomes a bad investment, right? To extend this over more years, we proceed in the natural way. So in this example, we now extend this to a CDO with 2 years, okay? We assume that defaults are 40 over the first year and 30 over the second year. Again, to make this simple, we assume that defaults have no recovery. And again, we are going to look at what are the internal rate of returns on each tranche. Okay, so we do the same type of analysis for each year. For the first year, we have defaults of 40, meaning the assets that generate income are just 300 minus 40, 260. Now I am assuming that the CDO has a maturity of 2 years. So in the first year, there is only principal, and then in the second year, there is principal and the final. In the first year, there's only interest, and in the second year, there is interest and the final principal. Okay? So year 1, interest of 8% of that gives me this. This is how much I need to pay. I go again by the waterfall from the top to the bottom tranche. Now I just have to pay interest. So 6% of 210, I have to pay 12.6. I have enough money, I pay that. Move on to the next tranche. I should pay 6. I still have 8.2. I can pay the 6, I'm left with 2.2. This goes to the equity tranche. Okay, so now I have to allocate the defaults to the tranches at the end of this year. Okay, and I do this allocation of losses following these waterfall rules from since I'm allocating losses now, I allocate the losses from the bottom to the top. Okay, so I have a loss of 40, meaning that I have to allocate them in this direction. So the principal of the equity was 30 in the beginning. I allocate to it as much as needed. So I have to allocate 30. I can only allocate 30 because that's the size of that, of equity. So that's what I do, 30. At the end of the first year, equity is dead. There's no more equity tranche. Okay? I still have 10 more million of losses to allocate, so I have to move on to the next tranche, to the mezzanine. It has a size of 10. It has a size of 60, so it can take the loss of 10 that I still need to allocate. So at the end of the first year, the mezzanine now has a principal of 50. Okay, senior is still untouched at 210. Right. So now I move on to the second year. Let's say the assumption was that defaults in the second year were 30. So the principal reduces by this additional 30. The interest is 8% of that. So now the cash flow matures. The portfolio matures, and we get principal and interest of this amount here. Right? Let's again go through the waterfall. Exactly same procedure. Senior gets 222. The senior gets the 6% interest in principal, which is this 222. The cash flow that we have is enough. We pay everything. So senior does not suffer any loss. Everything is as it was promised. The mezzanine already is smaller because of the loss in the previous year. So it's only 50. The interest rate is still 10%. The cash flow due is 55. I don't have enough money to pay that. I pay only what I have, which is 25.8. And the equity was dead already. Okay. If this went on for an additional year, I would need to again allocate the losses of this year from the bottom to the top. Okay. In this case, I don't need it because it's going to end right now. So what I do now is I look at the cash flows that I got through time and compute the yields on these tranches. So the senior was fine, got the 6% that was promised in the beginning, but the other tranches are losing money. So the mezzanine had a yield of minus 29%, and the equity was almost a total loss. It just got a little bit of return in the first year, but then everything disappeared. Okay, so this is a little bit the story of what happened in the credit crisis. You can see that this structure looks good in good market conditions, but if defaults start happening, very quickly you lose money on these tranches that you were thinking were more or less safe, but in reality they can very quickly lose money. Right? All right, so another version of these CDOs are the synthetic CDOs. So recall that when we defined here in the beginning, we could have CDOs whose assets were credit derivatives instead of actual bonds or loans, and these are called synthetic CDOs. Right? So the idea here is that the sponsor bank does not want to really get rid of the assets that it has in its balance sheet for customer relations, for example. So instead of managing the credit risk of those assets by sending them to the SPV, the sponsor bank manages the risk by trading a credit derivative like a CDS on those assets. Okay. So I think this is better illustrated with an example. The first synthetic CDO that was created and then that launched this market was this one here called Bistro. For some reason, these CDOs also always have some weird, fancy names. I think they first make up the name, the Bistro thing, and then they think of what are the words that match these letters to make this look more or less like something related to CDOs. Anyway, so let's look at the structure. This was created by JP Morgan in '97, and it's really an interesting development in this area. It's a very clever structure. So let me try to show you this with a figure. Let me open the drawing. Okay. So this is the idea. The starting point is JP Morgan, which has assets, loans and bonds, that money that they lended to their clients of this amount, $9,722 million. Okay, so a huge portfolio, and they are worried about the credit risk of this portfolio. They want to manage that credit risk, but they don't want to get rid of the assets. Okay. So what they do instead is the following. They create this SPV called Bistro, okay, which is structured in the following way. It's going to get some assets, which we'll describe in a second, and the right-hand side, the liabilities, are structured in this way that we have seen before. So there is this hierarchy. Here there is another another tranche, another layer, which is on top of the senior, so we call this super senior, okay? But it's exactly the same idea as before, in the sense that there will be a waterfall in the same direction, and therefore this super senior is the less risky tranche, and equity is the riskier tranche, okay? So the nice thing now is the following. These are the sizes of each tranche. So this one is very large, then you have the senior, the mezzanine, and the equity. The senior and the mezzanine are sold to outside investors. So this amount of money is actually coming in from outside investors, right? The other extremes, both the equity and the super senior, stay with JP Morgan, okay? Okay, so what does Bistro do with the money that it gets from outside investors? These $697 million are used to purchase treasury notes, okay? But then what they're going to do with that money is also interesting. So the way this credit risk is transferred to Bistro is through a CDS. So JP Morgan buys protection on these credits through a CDS issued by Bistro, okay? So that is the usual payments in the CDS, meaning that JP Morgan periodically pays a fee, and then if there are defaults in the underlying, the Bistro pays the loss given default, right? But JP Morgan wants to be really sure that they will have the money of the losses if losses happen. So the money that came from outside investors that was used to purchase treasury notes is actually already with JP Morgan, because these treasury notes are posted as collateral for the CDS. All right? So JP Morgan is very safe in the sense that this money came from here to the treasury notes, which are collateral for the CDS. So if there is defaults in these credits, the money to pay this is already here with JP Morgan, right? How does the Bistro work? Well, they have to pay interest to outside investors to pay for these notes here. How does Bistro get money to pay interest? Well, from two sources, from the coupons of the treasury notes and from the fee of the CDS. So these two sources give money to pay interest to outside investors. Okay. So and then it works exactly in the way that we have seen before. If everything goes well, meaning if there are no defaults here, then these payments go on over the life of the CDS and the life of the Bistro, which I guess was structured at 5 years. If there are defaults, I mean, if there are defaults here in these credits, these losses are in the end borne by the outside investors, because they lose their money, they lose their assets, and the losses start accumulating and hit the outside investors. Okay. Another way to look at the outcome of this for JP Morgan is to think of this initial concept we described in one of the first classes, which is the distribution of default losses. So what JP Morgan achieved with this was the following. The expected loss on this portfolio is still borne by JP Morgan. The equity tranche is still held by JP Morgan. This is the one that suffers the first losses. And this amount was set equal to the expected loss on the portfolio. Okay, so this is what JP Morgan was already expecting to lose. It was priced in the interest rate that they charge to their clients, so they still keep that amount of loss. Okay, the issue was the unexpected loss, that additional part that requires capital reserves. Okay, and what this is achieving is that JP Morgan is, instead of having to have capital reserves, is transferring the risk to outside investors, right? Obviously at the cost, which is this fee that they are paying on the protection, on the CDS. Okay, so I think it's a very clever structure. JP Morgan was very sophisticated in developing this structure, and it was the start of this synthetic CDO market. Okay, so that's how this works. So to conclude, what are the applications of CDOs? Why is this interesting? Okay. So there are two counterparties here: the issuer and the outside investors. For the issuer, this is the advantage is what we have just discussed. This is a way to manage the credit risk of the portfolio. Okay. Now for investors, what is the advantage? Why would outside investors want to buy these securities? So this is the nice feature of CDOs that is not easily achievable with other assets or with other structures. So if you think about it, what the CDO is doing is creating new securities that do not exist in the market. So if you think about what fixed income investors typically want, is securities with a low level of risk. So fixed income investors are things like pension funds, insurance companies, and things like that. And they would prefer to have securities with very good credit ratings, like AAA, AA, and so on. Unfortunately, so sorry, I had to stop the video for a second. So I was saying that fixed income investors typically prefer highly rated securities, AAA, AA, and so on. Unfortunately, in the market, what we have, for the most part, are corporate bonds with a rating around BBB or something like that. So not as high as investors would like. So what CDOs do is complete the market in the following sense. CDOs take the pool of debt that really exists, think of a rating like BBB, and then transform that big pool into different types of debt. A senior tranche that will have a very high rating, an intermediate tranche which will have an average medium rating, and the lower part that will have a very bad rating. Okay, so in a sense, this is like if you take the raw milk from a cow, you can make cream, you can make whole milk, you can make skim milk, so you can make all these different products that then cater to different types of tastes. So some people like to drink skim milk, some people like to drink whole milk, and that's exactly what it's happening here with the CDOs. Some investors will prefer to buy the senior tranches because they are looking for safer investments. Okay, and then since you put all the risk in some part to remove it from these senior tranches, then you give the remaining lower tranches to investors that are willing to take the risk, okay, in expecting the higher return, but that's the usual risk-return trade-off. Okay, so that's, again, the nice side of CDOs is this market completion. You take something that exists, which is average, BBB, and then you split this into different products, which will cater to different investors, right? So finally, what are the type of investors that will want the equity tranche? Well, again, investors that are willing to take risk, like hedge funds and private investors and that type of investors. But sometimes or commonly, the equity tranche is actually kept in the sponsor bank, like in this example we saw from JP Morgan. Okay, and that happens for two reasons. So as you can imagine, there is a huge information asymmetry here, in the sense that the sponsor bank, JP Morgan in the previous example, knows much more about the portfolio of credits that is being transferred to the SPV than outside investors. So to reduce this information asymmetry, or the problems that result from this information asymmetry, JP Morgan took the equity tranche. Okay, so the idea is that by taking that tranche, JP Morgan is kind of sending a message to outside investors to say that they will not do evil, in the sense that they will try to manage the portfolio as best as possible, because if they don't, they will suffer the first losses. And also, they will not put only trash in the SPV, in the sense that if they did that, they will also again suffer the first losses. So that's the more formal names for these problems are adverse selection and moral hazard. All right. So that's the story. Again, I think the CDO structure is very interesting, very useful. It is being used nowadays for other types of assets. I have some links on the course webpage about that. So hopefully this is something that will be used in the future for good and not to deceive investors and to create more crises, but rather to help investors achieve their risk-return trade-off that is best for them. Okay, that's it. Hope you enjoyed this topic. Thank you for watching, and I'll see you in class. Bye.